Now in the past in my videos, I've talked a whole lot about one of my favorite income-focused ETFs known as the JP Morgan Equity Premium Income ETF or JEPI. And also in the past, especially as of recently throughout this year, I've talked a whole lot about the NEOS S&P 500 High Income ETF or SPYI. But what I realized as of recently, I haven't made a video covering both these ETFs in the same video, comparing what they both have to offer, because these ETFs have a lot more in common than some investors might realize. So in today's video, we're going to do exactly that. We're going to look into both the JP Morgan Equity Premium Income ETF JEPI and SPYI, the NEOS S&P 500 High Income ETF, talk about what both these ETFs are, how they work, etc. And then towards the end of the video, I'm going to give you guys my personal opinion on whether I think JEPI or SPYI is the better S&P 500 focused high income ETF. So if you're an income-focused investor, and especially if you hold either one of these or have ever planned on it, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So first off, just to lay some groundwork, I personally own around 1,200 shares of JEPI across my portfolios, and I've owned JEPI for several years now. And I like this ETF for several reasons, which we're going to get into in a second. But the way this ETF works, it says seeking consistent premium income with lower volatility. It says JP Morgan Equity Premium Income ETF seeks to deliver monthly distributable income and equity market exposure, but with less volatility. Now the portfolio for JEPI, it says defensive equity portfolio employs a time-tested bottom-up fundamental research process with stock selection based on our proprietary risk-adjusted stock rankings. But with this discipline option overlay, implements written out the money S&P 500 index call options that seek to generate distributable monthly income. And since JEPI's inception, this ETF not only has went up in price, which has been awesome, especially since where I started buying it a long time ago, but also this ETF, just in the name, has distributed a ton of income to investors every single month, sometimes more, sometimes less, but anywhere from 30 to 40 cents more or less every single month. Now this gives JEPI anywhere from around a 7, 8, 9% yield, depending on which time frame you're looking at, which is a very solid amount of income to be earning on a yearly basis, especially for an ETF that, like I said, is also grown over time in price. But what about SPYI, another S&P 500 high income ETF that, like I said, offers a lot of things that JEPI also offers, but also does things a little bit differently. So SPYI says the fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. So far it sounds very similar to JEPI. They basically both invest in the S&P 500 and then use a covered call strategy in order to basically cap the upside, lower volatility, but also give investors exposure to massive amounts of income potentially. Now this is where SPYI differs from JEPI. It says it's actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. So this ETF is not only giving you exposure to the S&P 500, but along with that the cover call strategy, which at least if done right and if the market plays nicely can offer a ton of income, but along with that they're trying to do so in a tax efficient manner, which I can't speak for everyone, but I absolutely love that. Now on top of that, SPYI also offers this is one of my favorite parts about the fund. It says the fund's going to sometimes both sell and purchase SPX index options, which of course can provide income potential, but also can capture upside in rising equity markets. Now a lot of cover call style ETFs like this one and like JEPI, even though the strategy offers income potential because of that cover call overlay, it also sort of captures upside potential. So if days where the market is shooting up like crazy, cover call style ETF like these ones can of course go up in price, but are only going to be limited to a certain amount, and that's because of the cover call overlay. But with SPYI sometimes buying SPX index options, this allows the fund to grow substantially if of course the market moves up very quickly. Now looking at the distributions for SPYI, they're massive compared to JEPI, and keep in mind these ETFs are right around the same price as of right now, at least within a few dollars. But SPYI's payouts are anywhere from 48 cents upwards to 55 cents every single month, and keep in mind this ETF has not been trading all that long, it's only started trading since earlier this year, so we're gonna have to see how things play out later on. But at least if you ask me, the strategy is very sound for SPYI, which is why I personally bought so much of this ETF over the last year, and this is simply because I want more exposure to the S&P, I want more exposure to a high quality, data-driven call option strategy, and especially if the income is going to be tax efficient, sign me up. Now another thing to mention comparing the two, the gross expense ratio for the NEOS ETF is 0.68%, where JEPI on the other hand is only 0.35%. Now I personally never really get hung up with expense ratios just because I think it's all sort of part of the game. You have to pay to play if you want exposure to an ETF that's sort of going to be done for you. But still, as you gather more and more shares, expense ratio is still an important metric, so keep in mind SPYI cost about double. Now, to look into the performance of both of these ETFs over the long term, they've both done pretty good so far. SPYI in the max time frame is up around 6.77%, and on the 1 year almost up 9%. Now, keep in mind, I can't speak for everyone once again, but a lot of us are buying into these ETFs for income potential, high income potential that is. So whether or not JEPI or SPYI goes up 3%, 5%, 10% per year, honestly, it's sort of a bonus. We're buying into these ETFs to get paid 8%, 9%, 12% per year in income, and for me personally, if these ETFs grow along the way, that's an absolute bonus. But so far, both these ETFs that focus on the S&P and of course that cover call overlay are in the green on the max time frame. JEPI's been trading for a little bit longer, but it's up over 18.9%. Now, because of the fact that SPYI does offer the potential of buying SPX index options, I do think that SPYI, depending on what the fund managers do consistently, I think that this ETF has the potential to actually grow substantially if, of course, the market plays nicely during the same time frame where the fund managers are potentially buying SPX index options. Where JEPI, on the other hand, is probably only going to have so much upside long term because it sort of does a simple set and forget out of the money S&P 500 cover call strategy. Now, either way, these ETFs are probably not going to outperform the S&P 500 on its own long term if you ask me, but I do think these ETFs can consistently offer investors anywhere from 7 to 12% per year in income as far as yield goes. And on top of that, like I said, depending on what the market does in the interim, I think they could also both grow in share price over the next several years. Now, interestingly enough, over the last 2.19 years, if we were to compare both SPYI and stack it up next to JEPI, which one of these ETFs had given a better total return? Well, with a $10,000 investment and all the income, all the dividends, distributions reinvested, an investor would have earned around 13.3% on average per year if they bought into SPYI 2.19 years ago. JEPI around 12.2%. Now, with those dividends distributions not being reinvested, we're still talking 10 to 11%, which is still a very solid total return, at least if you ask me. Now, again, neither one of these ETFs have been trading for say 5, 10, 20 years, so the amount of data that we have to go off of is minuscule, but still over the time frame of 2.2 years more or less, SPYI actually comes in as the winner. So which ETF is potentially better to invest into? Is it SPYI or is it JEPI? Well, for me personally, like I said earlier, I own a ton of both. I own around 850 shares of SPYI and around 1,200 shares of JEPI. And this is simply because I'm a huge fan of both of their strategies. Both of the ETF objectives match exactly what I'm looking for, some upside potential and a ton of income along the way. And besides, who doesn't really want more exposure to the S&P 500, especially if it involves a strategy where a massive amount of income potential comes along with it? So now that we went over and compared JEPI and SPYI, talked about both these ETFs and what they have to offer, I lastly, most importantly, want to hear from you guys down below in the comments. If you, for whatever reason, could only choose to buy either SPYI or, of course, the famous JEPI ETF, which one would it be and why? Let me know down below in my comments. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.